friends, I'm back with the 7th part of our accounting series video. And in this part, I'm going to elaborate accounting policies. Topics to be covered: definition of accounting policies, prominent accounting policies, difference between accounting policy and accounting principles, importance of accounting policies, selection criteria of accounting policies. Accounting policies. Accounting policies are the rules and guidelines followed by a company when preparing and presenting its financial statements. These include any accounting methods, measurement systems, and procedures for presenting disclosures. Accounting policies are important as they set a framework which all companies follow and provide comparable and consistent standard financial statements across years and relative to other companies. Full disclosure of accounting policies is important so that potential investors can better interpret a company's financial statements. Prominent accounting policies. Some of the key policies used by companies are policies for accounting conventions, policies for valuation of fixed assets, policies for depreciation and inventory, policies for valuation of investments, policies for translation of foreign currency items, policies for costs incurred for research and development, policies for historical or current cost accounting, policies for treatment of leases, policies for treatment of goodwill, policies for recognition of profit on long-term contracts, and policies for treatment of contingent liabilities. Difference between accounting policy and principle. Accounting policies differ from accounting principles. The principles are the accounting rules and the policies are a company's way of adhering to those rules. Or, accounting policies are different from accounting principles as the principles are the overarching accounting rules, whereas policies are the way a company follows the rules. Accounting principles are fixed, predetermined rules set by financial authorities that a firm must adhere to regarding accounting and reporting. On the other hand, accounting policies may be defined as the personal modus operandi regarding how a business sets out to fulfill these principles. Accounting policies might change with companies and geographies, but generally, most of the companies around the world one of the two accounting standards. But generally, most of the companies around the world follow one of the two accounting standards or principles. First is generally accepted accounting principle, that is GAAP, and the second one is International Financial Reporting Standard, that is IFRS. Accounting principles are the all-embracing accounting rules, while accounting policies are the specific ways to follow those rules. Importance of accounting policies. There are several reasons as to why accounting policies are extremely important to a company preparing the financial statements, but also to the investor and the government. Number 1. Government retaining a hold on financial statements. Number 2. Proper framework. Number 3. Providing advantage to investors. Number 4. Disclosure. Number 1. government retaining a hold on financial statements. All companies has to follow some accounting standard of their country such as GAAP, IFRS, and IAS when preparing financial statements. It is the way the government can keep a check on financial statements and simultaneously protect the interest of investors. Number 2. Proper framework. As mentioned earlier, accounting policies essentially provide companies with a framework to report their financial statements, so they follow a standardized format throughout. Number 3. Providing advantage to investors. By mentioning to investors that they have followed particular accounting policies, investors can gain added confidence in the company and the numbers, and these statements can easily be compared to other companies' financial statements as they follow a standardized format. Number 4. Disclosure. A company must disclose the accounting policies they follow. The policies comprise separate rules on how to disclose information to investors, and companies should comply with adequate disclosure requirements. Selection criteria of accounting policies. Accounting policies can be selected to be conservative or aggressive based on company's motive. Conservative versus aggressive policies. Conservative accounting policies understate a company's current financial performance and show better financial performance in subsequent years. It is more sustainable approach, and it allows companies to show improvement over the years, which is a positive signal for investors. Aggressive policies tend to employ accounting policies in a way such that they overstate the performance in earlier years, and it leads to a decline in a company's performance in later years, even though the company may be doing. Aggressive accounting policies can also raise a red flag from auditors or investors if they feel management is misrepresenting earnings or allocating costs. Key points for selecting accounting policies. Companies work on certain key points for selecting accounting policies. Companies choose the following consideration as a basis of these policies. First is precise and accurate presentation. Accounting policies should clearly convey the account's information. Rather than making unnecessary adjustments, the policies must present every piece of information as genuine and simple. Number 2. Conservatism. In choosing among generally accepted principles, a firm's priority goes to policies that have conservative measures of net income. As business offers many uncertainties, a conservative approach towards benefits is always preferable. Accordingly, conservatism implies that policies form a major part of accounting. They must recognize expenses as fast as possible. In addition, they must delay revenues as long as applicable. This method minimizes cumulative reported earnings. Number 3. Profit maximization. Working in the opposite direction to conservatism, this technique supports maximizing cumulative reported earnings. That is, policies must recognize revenues as quickly as possible and to delay expenses as long as possible. Use of these accounting policies is that a firm generates profits. The report should be a favorable one. It must showcase a firm's growth. Number 4. Income smoothing. Another criterion for selecting accounting policies is income smoothing. As the name suggests, income smoothing works to make the flow of income easy. It suggests to first analyze the earnings, then minimize fluctuations in earnings. This will decrease risks linked with invested shares. In return, the chances of earnings will increase. The criterion also suggests net income, revenues, and expenses to be smooth. So basically, this policy works on taking shorter steps leading to an ultimate goal, that is raising profits. That's all for this video. Your feedback will be highly appreciated and will help us to improve the content. Join us on the next video to know more about accounting standards. Thanks for watching. Do not forget to click the subscribe button and hit the bell icon for latest updates.